Quest Trust Company. I apologize for the delay. It was just a comedy of errors this morning. But just like at Quest Trust Company, we are turning lemons into lemonade, and we are so happy to be here with you this morning. Again, I apologize for the delay, but it was well worth it because we have an amazing guest speaker with us today, Ryan Gibson, who's going to talk to us about the amazing benefits of investing in self-storage. But before we get to our man of the hour, we have some amazing news to share with you about Quest Trust Company, little information about us. If you're new to Quest or new to investing with us or don't know so much about us. So let's get started. So who is Quest Trust Company? What do we do? We are the largest self-directed IRA custodian in Texas. We have about 20,000 active investor clients all over the country. So no matter where you are joining us from, we are able to help you. We are able to open a self-directed IRA for you and help you invest in amazing private assets like self-storage and other private assets, of course. About 2 billion assets under administration. Notice I didn't say management. These are self-directed IRAs, so you are in control of everything. We'll go over that in a little bit. 100 employees in our 3 offices, our main office being in Houston, and we have offices in Austin and Dallas as well. I think we're up to about 36 or 37 certified IRA service professionals. Our moderators, Sarah Shellum in our marketing department in our Austin office is one of them, as myself, and we have some other new employees who received that designation this year, so we're really proud of them. And we have about $400 million in undirected cash. This is cash sitting in our clients' accounts that is just, it's not directed, it's just sitting there. So it's waiting for an opportunity to be invested in other private assets or to be lent out to fund those investments. So lots of opportunity there. Of course, we have to go over our disclaimer. Quest Trust Company does not provide any tax, legal, structuring, investment advice whatsoever. We are absolutely here to support you and give you a lot of education, bring lovely events like this to you, some networking events. But we ask you to please make sure you're checking with your CPAs, your tax professionals, your attorneys, what have you, before engaging in any investment and investor. So make sure you're doing your due diligence there. All right. So what is a self-directed IRA anyway, and why should you have one? So honestly, self-directed is a completely made up term. It just means that you are absolutely in the driver's seat. You are directing these accounts yourself. You are choosing the private assets. Quest does not hold anything publicly traded. We only hold private assets. We have a very open architecture platform for you to choose your own private assets. You let us know what you want to invest in, and we help facilitate that transaction. So according to the IRS, there's absolutely no such thing as a self-directed IRA. It's an IRA that you're in control of. Same contribution limits, same exact rules for compliance. We just have that open architecture platform for you to invest in all the private assets you would like to, of course, that are not prohibited. So what are the benefits of having a self-directed IRA? Of course, diversification. There's so many different private assets to invest in. That can be a diversified asset class on its own, right? Or it can be a diversified piece in your retirement portfolio as a whole. So maybe you do want some, and there's nothing wrong with publicly traded assets. I used to be a broker. But so maybe you want that piece of the puzzle. Maybe you want some private assets and some other diversified things. Also, every single one of the 7 accounts at Quest Trust Company does have a tax advantage or a tax savings, whether it be tax deferred, where you pay the taxes at distribution for retirement, or tax free, like the Roth account. Happy to tell you about that more. Make sure you contact your IRA specialist. We're happy to help with that. Social investing. I really like this aspect of self-directed investing. So you're really choosing these investments. You're choosing where you want to invest. So maybe you are doing a fix and flip in an area that you really care about, and you are improving this area. Or maybe you are doing like a self-financing investment where you are affording someone a mortgage where they normally couldn't get a typical one. And of course, invest in what you know best. I love this as well. Not everybody knows about the stock market or what have you, but maybe they know a lot about real estate, or they know a lot about oil and gas, or a lot about notes. So this is where you can use your education you already have to help yourself save for retirement or get some great investment benefits. Investment choices. This is really a short list. So self-storage is not necessarily listed on real estate, but it's absolutely investment you can do in real estate. So these are kind of the three main asset classes that we deal in. But of course, there are so many things in each one of these asset classes that you can invest in. Make sure you're contacting your IRA specialist. We're happy to help you, discuss what investment options are there for you. We're happy to give you some resources. Even if you're already a client, it's a great idea to schedule an account consultation with us to make sure you're getting all of the advantages you can out of the accounts. Of course, we love to give some free education, like the classes you have here. So Tuesday at noon, Saturday at noon, we love to give you a new class, new topic, new speaker on all things self-directed IRA. And of course, we have national networking on the last Wednesday of the month. We just had ours for September. Oh my goodness, it's October 1st. It's wonderful. I love to host this event. This is a great event for those that can't come in person. Everybody gets to have about a minute on camera, put their information in the chat box, share that contact information. So make sure you check out that class. Anything that you miss, always recorded on our YouTube channel as well as streaming live. So you can always go back and go back to those webinars and get that information you need. Oop, I missed something. So of course, all of our in-person socials. So Houston, first Tuesday of the month. Our Austin office, second Tuesday of the month. Dallas, third Tuesday of the month. Please come join us for some in-person social networking. Meet some vendors, get some education. You can deal pitch at the end, or they have deal pitching at the end. So lots of great opportunities out there. We'd love to come have you. Of course, we provide some food and adult beverages for you. So we'd love to have you come join us for that. So I hope everybody is still reeling from the excitement of the Quest Expo like we all are. We had Ryan there and his company out there. It was fabulous. I had the luxury and the pleasure of hosting Ryan and some other great speakers on a panel, and it was so much fun. So we are having QuestCon Live, a forecasting event for 2023. So December 9th and 10th, tickets are on sale now. We're really excited about this event. It's kind of a recap of 22 and forecasting 2023. It will be a 2-day event. This will be virtual. So we're really excited about putting on yet another wonderful event for you. So really excited about this one. Check out, I keep doing that. Sorry about that, guys. So make sure to check out our website for more information on this coming up. For those of you wanting to know, the Quest Expo recording will be available. I believe it is October 19th. It could be the 17th. I am pretty sure it is the 19th. The recording will be available for those of you that purchased it. It is still available for purchase. If you haven't, I will put that information, or our lovely Sarah is going to put that in the chat box for you. All right. How to get in touch with us. We would love to help you out. If you go to our website, you can chat with us live. It is actually us, the IRA specialists and transaction specialists, helping you out. Call us. I love our phone number, 855-FUN-IRAs. We really do think this is fun. We'd love to help you out. Email me. I'm happy to help you. Our IRA specialist, nicole.baco@questtrust.com. I should have made that a fun quiz. Who can pronounce my name? Or IRA specialist at questtrust.com. We would love to help you out. Okay, quite enough from me. Let us get to the man of the hour, and let us talk with Ryan. Hi, Ryan. How are you today?
Good, Nicole. Good to see you again.
You too.
Yeah, good to see and meet many people at Quest Expo. That was probably the best conference I've been to pre and post COVID. So thank you so much for your good work putting it together.
Oh, it was a pleasure. Have you come down from the excitement yet? Gotten any rest?
Yeah, I was on the road actually for like 3 weeks. So that was rare or different for me, especially coming out of the pandemic. So yeah, just met a lot of really great people, and it was really cool seeing Quincy honored, and it was a lot of fun. So
awesome. Well, thanks again for being with us for the expo. And of course, thank you so much for being here this Saturday with us, sharing more of your information on self-storage. So I will let you take it away, and thanks again for being with us.
Thanks, Nicole. So my name is Ryan Gibson. I really appreciate the opportunity to present. Many of you saw my presentation at the Quest Expo, so I tried to change things up a little bit, not give the same slide deck, and sort of what I wanted to talk about is sort of where we think the state of self-storage investing is in 2022. Obviously, we have rising interest rates. We have uncertainty in the economy. We have recessionary claims and counterclaims. We've had 2 negative quarters of GDP decline. And so I think it's really important to kind of understand where asset classes are and kind of where you're investing and what you can do about it, how you can position yourself for success. So I've put together a significant amount of data that talks to kind of where we are with in respect to self-storage. And just to kind of give you an idea of kind of where we're coming from or what Spartan does, we are the 40th largest owner and operator of self-storage in the United States. And so when we look at the industry, our company constantly is comparing ourselves to the publicly traded REITs and what the rest of the industry is doing, and it gives us a good perspective on where we're going. But just to kind of give you an idea of my background, kind of where Spartan started and how we got to where we are today, it first kind of started with a house in Washington, D.C. I live in the other Washington now, in Seattle, Washington, but this is where it all started. This house right here is just we started off flipping houses. My previous experience as an airline pilot there, my daughter on our first flight to Hawaii, I was an airline pilot actually working out of DCA, Reagan National Airport. And one day a guy was walking down the street who happened to be an Army vet. His name is Scott Lewis, and him and I, he bought the house to the right of the house in the center, and I bought the house to the left of the one in the center. And that's how we became friends and eventually started Spartan Investment Group. And it started with that first flip right in the middle where we found this abandoned house that just happened to be right next door to our homes. And we put together some cash and we flipped the house and made a nice profit. So, but just to kind of talk about where we are today, we're basically the 4th fastest growing private real estate company in the United States as ranked by Inc. magazine. And again, kind of overall the 126th fastest growing private company. And we're the 40th largest operator in the United States. And all of our storages are branded under our Free Up Storage national brand. And if you're in Texas, you'll see that we have quite a presence in the DFW Metroplex, and then one of the largest operators in Tyler and in Longview, Texas. So just a little bit about us: 25,000 units, about 100 employees. We've made the VET 100 the last couple of years. We have about $500 million in self-storage. We've been a fast-growing company, ranked the last 3 years by Inc. And we've secured about $200 million of equity across our projects. And just to give you an idea of where we concentrate on our facilities, this is where we look, and this is where we buy property. So you can see that we're heavily in Texas and then in the southeastern United States, with a sprinkle in the Pacific Northwest and the Midwest and Colorado. So we do everything. So vertically integrated company, and some of the perspectives that I give today on construction starts and cap rates are really kind of based upon that we're vertically integrated. So we do everything from acquire the property to build the property to property manage. We syndicate the equity and then we secure the debt. So we handle all aspects of the operation. Typical projects look something like this. That property on the top left there is in Tyler, Texas, right off Broadway, and the properties to the top right are in Wisconsin. That's just outside of Milwaukee, and then the top right one is just in Madison, Wisconsin, and then the 2 pictures below is actually a facility we built just outside of Seattle, Washington. So those are some of the Class A properties we do, and we typically do value add potential as well with the bottom properties there. Bottom left-hand picture you can see is in the Atlanta, Georgia area. We buy these properties that are kind of a little run down and need a facelift. So we put in drive aisles, paint, doors, cameras, security, pave the drive aisles, and make the facility kind of look nice, clean, and secure so that we can increase value add through that way. We also buy a lot of mom and pop owned facilities. The bottom 2 there, mom and pop owner in the DFW Metroplex that we purchased a big portfolio from, where we come in and improve the operations. Our typical projects look something like this. We're actually going to walk through a case study today where there's existing facilities in place and then additional units are built in that vacant land to expand, and we improve operations and then obviously put our brand standards. So we operate everything under our Free Up Storage national brand. So we'll rebrand a property and bring it up to our standards. We also do ground up development sometimes. We do about 1 ground up development a year. We won't do a ton of this. And we'll go everything from what I call trees to keys, where we entitle the property, get the permits, and then we do the raw land development. And this is kind of a project outside of Seattle where we took it from raw land and then we graded the property and took it through all its permits and development and built a beautiful Class A facility that you can see here that has about 755 units in it. So we do kind of both things where we buy existing and then build from the ground up. But why storage, and where are we at in the state of the economy? For those that are familiar with self-storage, this might be a little repetitive, but for those who are kind of wondering what's the deal with self-storage, I've heard a lot about it. Where are we at? I always like to say that there's more Starbucks, McDonald's, and Burger Kings in the United States than there's fewer Starbucks, McDonald's, and Burger Kings in the United States than there are self-storage facilities. And in fact, if you combine all the fast food chains, there's only 50,000 or so, and there's about 60,000 self-storage facilities. And what's interesting is 1 in every 10 Americans uses a self-storage facility, and 66% of those users they have a garage in addition to that. And some people might think that self-storage is a thing because Americans have too much stuff, or they're hoarders, or they accumulate too many belongings. But the reality is self-storage events are because of one thing, and that's life events. When I think about using self-storage, it always is a disruptor. It's a move, a downsize, a relocation. Somebody's getting divorced, somebody passed away, or there's some kind of an estate sale, or somebody is simply just expanding their family, like I did recently, where I had to tear apart my house and put all my stuff into self-storage. And that required us to use self-storage. And my thought was, well, I'll just use it for a couple of months. And it ended up being about 8 months or 9 months that I use the self-storage. And that's kind of our typical customer has that same sort of story. So life events are what drive self-storage. And the reality is life events are not going away. And in light of recent economic disruption, we see that the self-storage will continue to increase and continue to have rising rents, and we'll talk about that a little bit today. $87.89 is the average cost of a unit, and it's a $39 billion industry in terms of revenue, about $88 billion in facilities throughout the United States. And one thing that has been just a real standout in storage is that if you look at this chart, the blue is all the real GDP growth over the last 4 recessions, and you can see every time there's a significant drop in GDP growth, self-storage occupancy has remained very steady, and that's the gold bar going across the top. And even with the recent decline in GDP growth in 2020, self-storage not only stayed consistent, but actually was kind of at its highest occupancy levels in recent time. And what's even more impressive about it is if you look from 2010 to 2020, or 2020, you'll notice that there's been an increasing amount of self-storage occupancy. And this is especially impressive given how many self-storage facilities were built in the last decade. We're talking about 1,200 facilities coming online every year in 2015. And despite all the surge in additional supply, those facilities have generally filled up, and occupancy has only continued to increase. And even if you look back 40 years, if you look at self-storage occupancy, when there is a lot fewer facilities available, self-storage occupancy has always remained constant. And I think it's worth talking about this because self-storage is like cell phones in 2006, 2007, where if you remember, you had those holdouts, right? You had those people that, oh, I'm not getting a cell phone. I don't need a cell phone. And then maybe they sort of opined and got a cell phone eventually, but it was a basic one, like a flip phone. And then it turned to, I don't need an iPhone. That's unnecessary. Now you look around and everybody's got a smartphone now, for the most part. Even my dad, who was probably the last holdout. But this is kind of like self-storage. Now that there's one in every single city, in every single town, now people know it exists and they use it as a tool. So when they move, they use self-storage. When they downsize, when they relocate temporarily, and it's become a more commonplace thing that people use in the environment that they're in, or in the local community that they live in. So it's really become well known. The other thing is that businesses use self-storage heavily. We find that 30% of our customers are business users. they're Etsy or Amazon businesses, or they're staging companies or entrepreneurs that need an extra spot to store their belongings. And that provides them a tool to get a storage place or a place to store their belongings that is much cheaper than the rising cost of housing, the rising cost of office space, etc., and just real estate in general. The other thing that we really noticed is that during the pandemic, people had to free up rooms. They had to free up their houses to work out. They had to free up their houses to work at home more permanently. So we've seen in the industry in general continue to raise rates and continue to increase in occupancy. So just kind of a fun chart to show, talking about storage occupancy as it obtains or compares to real GDP growth. So when we got into self-storage, I like to show this graph. Self-storage was going off the charts, but really why Scott and I wanted to get into self-storage was because it was recession resistant. And, you know, as an airline pilot, formerly and a military vet, we really concern ourselves with risk mitigation. You know, if I make a mistake as an airline pilot, like a lot of bad things could happen. Same with Scott on the battlefield. So why we saw this green line here showing how well storage performed against all other REITs and the S&P 500, we were mostly attracted to how well it did during the last 4 recessions. Specifically in 2008 and 2009, it did very well as compared to all the other REITs, and then continued to grow and climb beyond that. And so when COVID hit, this really started proving out our thesis that self-storage was a life event driver, because everybody was closed up, people were masked up, people weren't on the move as much, but self-storage growth, revenue growth was up 12.7% year over year, which is just incredible. And partially to blame was, a lot of the eviction moratoriums that multifamily and other single-family homes in some blue state markets really were a victim of. Self-storage didn't have the same eviction moratoriums, and we didn't have the restrictions put on us to where we couldn't kick people out or raise rents or go through the eviction process. And as we like to say, nobody really cared about this old dresser, but they did care about kicking people out of their homes. And that was one thing that was really protected by the government. And this is what happened during that time. Self-storage just absolutely blew up. And I'm going to talk about what happened to cap rates during that time, during COVID. Public storage specifically bought $3.3 billion during COVID. Blackstone jumped into the game. They bought the Simply Self-Storage platform and went on an absolute buying spree. Bill Gates started buying up self-storage as a large majority share owner of StoreMart. And then Inland Private Capital Group monetized a huge portfolio, $265 million. Simply, again, this is the Blackstone brand, went and bought about 10,000 units across Houston and Dallas. And then CubeSmart jumped in at $1.69 billion in acquisitions during COVID. And the Wall Street Journal started picking up on just how hot this property was during the pandemic. Spartan, we acquired about $265 million in 2021. And this was an article that got picked up in Q3 last year as we were finishing up the first part of the year for acquisitions. So how did storage do during COVID? And this is just a really interesting chart that was provided by Newmark. And it shows the year-to-date REIT percentage growth as of December 2021. And you can see, just as we were kind of peaking in the pandemic, or coming out of the pandemic, self-storage REITs were performing at 71%. And you can see how the other real estate REITs did, multifamily, industrial, et cetera. And it just was one of the least challenged by the COVID-19 pandemic. Now, when the COVID-19 pandemic hit, a lot of these REITs went down in value. So you can see here the gold bars represent the impact that COVID had when the pandemic first settled in. So January of 2020 to May of 2020. And you can see that self-storage took about a 9.4% hit, due to speculation, most likely. But all the other sectors had much bigger losses, with the exception of industrial and single-family homes and the S&P. But the return of the resurgence, the overall growth during the pandemic was far and above all other asset class types and was up 82%, which is phenomenal. And so you might wonder, okay, so what's the cap rates and how do they compare to apartment investing? And then, and for self-storage, the average cap rate's about 4.93% as of quarter three, 2021, and apartments about 4.69%. Now you might be thinking, man, that's like a really the really low cap rate for self-storage. I thought, I saw a self-storage that was trading at a 7 or 8 cap. This is for institutional quality portfolios. We're talking about Class A, really nice vintage products, or in markets that have really strong rent growth and great opportunities. And this is just kind of some historicals. 2015, the bottom right there, you can see that cap rates were between 4.8 to 6% for trailing kind of going in cap rates financially. And in 2021, that declined about 85 basis points, or over 85 basis points just in the last 2 quarters of 2021, down to in the low 3s to the high 4s, which is just absolutely incredible growth in valuations. And overall, we're just seeing large portfolios trade somewhere around that 4% cap rate. So when we started in self-storage, the year was about 2014, 2015. And the biggest thing that was talked about at conferences was all the self-storage being built. A lot of people can drive through any town, you can see them going up all over the place. And that was our biggest threat. And you can see here, in about 2017, we have data that shows that in 2016 and 15, there was over 1,000 new constructions being built every single year. And you can see in 2017, 960 new facilities were built every year in the United States. And in 2021, it's dropped to 400. And this is a pretty significant thing to focus on. And obviously, this is continuing to decline as the disruptions to the supply chain happen, and also construction costs go up to the point where it may not justify being able to build a self-storage facility. This supply constraint has only caused rents to continue to rise due to lack of inventory of self-storage and need. So if you can think about lowering the supply and increasing the demand, that's kind of where we're at today. And I kind of wanted to underscore why. So in 2017 to 2019, when we would look at a property, we could make it work if it was about $80 per month rents on a 10 by 10. And that was what required to pencil the project to build. However, as construction costs just absolutely skyrocketed in 2020 and 2021, now our costs to build have just absolutely increased by a pretty significant factor to $12 to $16 rents, or about $130 a month for a 10 by 10. And so you can see a lot of markets just didn't pencil anymore, and so the construction starts are way down. So if you own these assets already and they're already built, good for you. You have a very low cost basis, and the likelihood that a competitor is going to come in and build around you is very low because the rents just don't justify the new construction. The other thing that I'd like to talk about is Q2 2022 REIT performance. And I think it's worth underscoring Extra Space Self-Storage, which led the revenue rent growth 18% year over year ending quarter 2, which is just absolutely incredible. You can view this blog on our website, spartan-investors.com. We do a whole analysis of the REIT performance data. We kind of compile these numbers together to inform some of our own underwriting and our own internal decision making on where we should take rents. And what I think was most impressive, though, is actually the lowest T12 rent growth was out of CubeSmart at 14.2%. Not too shabby year over year rent growth for the REITs. And the new forecasts for 2022 show that revenue growth is about 13.5%. And just for context, we usually expect about 3 to 8% annual revenue growth in our portfolio. So we're always a little bit more conservative than the REITs, but it's really a great forecast for the remainder of 2022. So our outlook for 2022, first of all, it's worth noting that we just increased rents in our portfolio across all 60 stores by $182,000 a month. So we're continuing to grow revenue, we're continuing to raise rents, and we see that not slowing down through the remainder of the year, even despite being in our seasonality of a low period right now where we typically, when you go into the fall and the winter months, self-storage has a little bit of seasonality dips and then it picks back up in the spring. That's been the tradition for many, many years and has a lot of data to back it up. We see that interest rates are going to continue to climb another 125 to 150 basis points per the Fed. And that's going to put pricing pressure on properties. And it's also going to slow down the number of transactions. Maybe sellers won't go to the market and they won't sell. They'll wait. Or perhaps they're in a desperate situation, need to sell, and that might allow you to retrade. But we see that that's going to be continuing to slow and due to pricing and interest rates going up. And we see opportunities in sellers holding the paper or doing seller financing as a way to transact or buying the facilities with all cash. Because here's the thing, even though interest rates are up and trending up, NOI and revenue growth is also trending up. So we see this industry going in the right direction. However, the underlying interest rates of today aren't necessarily beneficial to the financing that you might be able to obtain on these properties in today's environment. You know, I think the old saying goes, date the interest rate and marry the property. I think these properties are positioned for success, and self-storage will continue to have a great story and great headline, but the interest rates may make it difficult on some of these transactions. And again, typical seasonality, but overall continued rent growth. So I wanted to take a moment here just to talk about a case study for one of our facilities, specifically the Mini West facility that we purchased in April of 2019. This property was built for $6 million, or purchased for $6 million, and it had about $443,000 a year in NOI, and we purchased this at a 7.38% cap rate, which I only could wish we could buy properties for that kind of cap rate in today's climate, but this was back just over 3 years ago. What's interesting, when we buy facilities, we typically have things that come with them. And in this case, this property came with a car wash on the front there. And we're not car wash operators. We're strictly self-storage. That's our focused niche. But we ended up selling that and returning investors' capital a few years earlier than planned. And then we had vacant room to expand. We have these 2 acres here in the bottom of the screen where we could build additional units. And then the facility came with some U-Haul truck rentals. But here's a little flyover of the facility. You can see that we have existing units, nice drive up and inside units. And we came with 735 units total, and it was about 98% occupied, about 81,000 square feet. And again, climate controlled units, which is very popular in Texas. And then this car wash that we sort of had to deal with, we ended up selling for $1 million, which was great. And then we also had U-Haul truck rentals that provided ancillary income for the facility, so it allowed us to really diversify what we were doing. But what we love most about this is that it came with this 2 acres of expansion, which we turned into these new buildings here, about 240 units. And you can see this is our construction crews out there. They're building the units, slab on grade foundation, just really simple constructions, standing seam roof, metal buildings, and it really came out nice with 240 new units, about 40,000 square feet of additional expansion. And the units were some interior brand new units, so for climate controlled, and then some exterior units as well. This is our team working with the Chamber of Commerce to celebrate the transaction and better advertise the units. And that's kind of a typical project for Spartan, right down the fairway, value add. So how do we finance and source these deals? Well, first of all, you need a stack of capital to buy them. And typically what we do is we raise money from equity investors, private individuals, and we raised about $2.3 million to buy that property. We had to go out to a bank to buy that facility and get a loan, and we got a loan for about $5.2 million, and that totaled about $7.5 million. The purchase price, now where did that money go? First of all, we had to put $6 million to the purchase price. We set aside $1 million to expand it. We had to put away $250,000 in reserves for that rainy day. And then we had about $250,000 in closing expenses and property management fees and things like that. We put our property through a strict 60-day rigorous due diligence process where we had a 700-point due diligence checklist that we completed. And that required us to put up $60,000 of earnest money to kind of hold our spot on the contract. So you might be wondering, if you're buying a facility, if you're thinking about buying your own self-storage, or you're evaluating maybe investing in a syndication or a fund, what do you need to kind of have in your underwriting? And first, the first and foremost, you need a rent roll. You need to understand how many units there are, what you can charge for them to really drive the rest of your underwriting file. You also need to understand unit mix, P&L, bank statements from the seller, property tax data, put your assumptions in on interest rate and financing terms, and then you need to do a market study. But that's a lot of little data points. So we share our complete checklist for those that want to go and download it. It's on our website, spartan-investors.com. It's kind of on the very first page right before our GRIT acronym. You can download that and you can see kind of all the things that went into buying this property, and then all the things that we check off on a due diligence checklist. So what's the first thing you get? You get a rent roll. So that's what we did in this case study. We got the rent roll of all the tenants, what they were currently paying, all their unit mix, and it's just a snapshot of your customers. And a rent roll will look something like this. It'll have all of the units, it'll have all the names of your customers, what they're paying, what units they're in. Sometimes you have prepaid expenses, etc. This is kind of an overview of the unit mix and all of the things that we go into buying. And then we look at our profit and loss inputs. This is basically a peek under the hood of all of the expenses that the seller was going through in their operations of the project. And it's really important that you try to get maybe a trailing 12 or a trailing 24 financials if you can. And that allows you to have some data to look at to make sure that you're buying what you think you're actually buying. And this requires us to go through the bank statements. So in this particular case, we wanted to go through the seller's bank statements and reconcile that against the P&L. And people ask, should I look at all the bank statements and all the transactions, or should I just sort of trust what's in the P&L? And our thing is every single bank statement should be looked through, and every single transaction should be verified and validated in the P&L. And that's what we do in our due diligence process. And the next thing you want to do is you really want to understand what your assumptions are. Are you going to lose customers when you take it over? This is your first time buying a property. If this is your first time buying a property, you might want to assume that you're going to have some frictions when the property turns over. You're going to have things like look at like lease rate, friction, turnover of the tenants, move-ins, move-outs, and all those other things. The other thing that you want to look at is the market. And so in this case, we went to the market and we mystery shopped all of our competitors that surrounded the property, and to get a really good understanding of rates, market occupancy, market data, and really kind of compare our subject facility to what the market was doing to really understand if our assumptions in the underwriting file made sense. And this usually means a market study. So in this particular example on the screen, you can see that for like a 10 by 20 unit, the seller was only charging an average of $135, but the market was charging $155. And that represented an opportunity to bring rents to market and really increase your NOI and overall value. And we did this for the entire rent roll. So this is the analysis that we did on the property. You can see this was pulled back in December of 2018 when we were under due diligence for that investment, and we saw that there was a gap between what they were collecting and what the market was collecting. And that's a really important thing to understand if you're trying to drive value in a facility by bringing rents to market rates. And if you look at these are 5 by 10s. You can see the size description there, 5 by 10s. And we're going to go through one example of how these 67 customers were being charged $47. But you have all these other customers that weren't being charged $67. And if you added all that up, we found that there was a gap of $165,000 a year between what the seller wasn't charging and what he could charge based on what all of his competitors were charging. And that was a really incredible opportunity to add value to self-storage. That's how you do it. You look at the rent roll, you look at the market, you do your study, and you know what you can charge based on occupancy and income being charged in the market. It's a very important thing to understand. It's also important to understand how conservative you are when you go into a facility. So for example, this was about our fourth or fifth purchase ever in our company's history. And so we didn't underwrite just going in day one and raising rents to $165,000. We actually conservatively underwrote raising rents $72,000, so nearly less than half of that over an 18-month period. So you really have to understand what's driving the underwriting based on your market study and what the operator has intended to do. And this adds about $66,000 of monthly cash flow and 1.02 of value. Well, the next thing that we looked at was, okay, we have these 2 acres, but what can we do with it? And you can't just go in and assume that you can build whatever you want. Even though it might be Texas and it might be a little easier to build, you have to get a civil engineer to really understand how much can we actually build. And so you look at this nice perfect square. The next screen, you see that same square. It's angled a little bit differently, but you can see on the left-hand side of the split, we had a gas line easement, we had to put a stormwater pond in, and really that 2 acres of usable land turned into about an acre of usable land. And so we determined that we could build only 40,000 square feet on that site. But given the market, given the conditions, we wanted to be conservative. So we only underwrote or only projected building 20,000 square feet of self-storage. And so we underwrote a $1 million budget. And we wanted to give ourselves plenty of time in the underwriting to build the facility. Now, these facilities only take about 4 to 6 months to build, given the single-story nature of the property. But we gave ourselves 24 months in the underwriting to actually deliver the expansions, which gives us plenty of time. Now, you may hear that these facilities fill up overnight and there's so much demand. Now, not all facilities are created equal, and so we gave ourselves a 15-month lease-up period. So even after we built it in 2 years, we would have 15 months thereafter to lease it up. And that's really important to bake in that conservatism. And this would add about $2.34 million of value. And so our plans for growth, we wanted to fix up the property a little bit. We wanted to increase collections by bringing those rents to market. We wanted to expand the property and then add ancillary revenue items like tenant insurance. Tenant insurance is an easy ancillary revenue item that we add to our facilities where we can simply just require all the tenants to have tenant insurance, and then we have a preferred vendor we use, and they share the tenant insurance revenue with us. The other kind of less known thing is, how does depreciation work with storage facilities? You may invest in multifamily, and multifamily gets depreciation, or oil and natural gas. Generally, you can get a cost segregation study done on a self-storage facility, and in this particular case, our cost segregator estimated getting about a $1.7 million accelerated depreciation in the first year. And so for those that invest with taxable funds, that means that you're usually going to have losses in your first year of the investment. And if you look up there in box 1 and 2, you can see that this investment on a $50,000 investment had a $21,000 loss per 50K invested, which is great because this facility projected cash flow. And based on a $50,000 investment, you can see that the cash flow each year was about 7.0% to about 7.7%. And then there's also, of course, the sale. The investors profited from the sale of the facility, and that kind of equals about a doubling your money in 5 years. And that was the investment projections. The reality is that with that depreciation, you get the benefit of that bonus depreciation based on the 50K invested. And so for 4 years of cash flow, you're blocking a lot of that taxable income and pushing it to the sale of the property. And that really helps benefit investors from shielding taxable income. Now, if you do it in your IRA, you obviously have the tax benefits that IRAs bring along with it, and obviously it could be a deferred or a preferred way of investing. So how did it go? We talked about at the beginning of the facility, we bought it, had about $443,000 of in-place cash flow. Then we talked about how we were going to raise rents to market. And then we talked about adding on additional units. So what happened? What happened and where's the property today? Well, first of all, we proposed raising those rents about $72,000 a year, but we actually just ripped the Band-Aid off and we increased the rents $205,000 a year pretty much right out of the gates, which is just an incredible, the facility stayed well occupied and just really turned out to be a nice investment. Now, we said that we had the 40,000 square feet to expand, but we just weren't really quite sure what we were going to do in the expansion. Was it going to be 20,000? Was it going to be 30,000? But we just underwrote increasing that facility size by 20,000 square feet, or about $155,000 a year in additional income. Well, the reality is when we went out there, we said, hey, it's actually more efficient to build more square footage all at once than it is to do this piecemeal. So we had savings by doing that, and we ended up increasing the facility size by 40,000 square feet, which added about $300,000 per year of income to the investment. Then we all know we had the 443 of existing NOI, and in our business plan, we called in 5 years to raise NOI to $670,000, or about a $10 million value, up from the $6 million when we purchased the property. And that would be based on a 6.6% cap rate at sale. Obviously, cap rates are much lower than that now, which is a great thing. But today, we're actually realizing, I literally just looked at the financials, we're NOIing after debt service $952,000 a year actually of NOI, which brings the facility value to $14.4 million. So we've just absolutely seen a phenomenal opportunity in self-storage, and this case study is just kind of a great example of that. Investor distributions have ranged from between, depending on if you're talking about your original cost basis or not, anywhere from 9% to 15.07% cash on cash paid out monthly. And we've also returned 40% of our investors' capital, because when you buy these properties and you have multiple parcels surrounding an investment, you can sell those parcels off and return your investors' capital early. Well, in this case, we sold that car wash because we don't want to own car washes. I mean, there's nothing wrong with car washes, but that's just not our expertise. So we sold the car wash, and that cash was returned to our investors many, many years earlier. A refinance or a sale of the facility is planned about a year earlier in 2022, and the investors will still profit from the sale of the investment. So how does this case study, how do we do investor communications? Obviously, we communicate to our investors on a monthly basis on the first of every month. We do investor teleconferences every quarter with our investors, and then we send out statements. And if you have any questions about any of this stuff, you can always email us at investors at spartan-investors.com. And you'll see here, this is our sign-up page on our website. We have a newsletter that actually goes out on a weekly basis. We also have a monthly meetup, and we are really focused on thought leadership and self-storage. So if you want interesting articles on how to build self-storage, how to find good locations, our newsletter is a really good resource for that. And that is how you sign up for it on our website. But Nicole, at the end here, so if anybody had any questions, I'm happy to jump in and answer anything that somebody might have.
Hey, Ryan, can y'all hear me?
Yes.
Okay, good. Of course, my electricity went out this morning, so that added to our comedy of errors. So now I am at my local coffee shop. So just making sure everything was connected. Ryan, as always, thank you so much. I actually was looking for a presentation in self-storage that a client was asking for, and I was searching for them. And I actually found a presentation that you and I did together on self-storage from about a year ago. So every time I listen to the presentation, of course, I spoke with you on a panel or two at the Quest Expo. I learned more and more about the industry, and I actually have some questions of my own and comments from the presentation.
Uh-oh. Did we lose Nicole?
Nope. There we go.
Nope. You're back.
just par for the course for the day, but we're going to work this out.
I think it'll have to, well, the Southeast doesn't have internet right now, probably, so we have a lot of sympathy, empathy for you. So.
Are you in that area that was affected by
No,
the?
I'm in Seattle. We don't have
That's true.
hurricanes here, but we are preparing for probably a pretty epic earthquake at some point.
Oh,
So,
gracious.
yeah.
Well, here's to the Saturday of the comedic errors. Okay, so I heard this fact at the expo, and I wanted to bring this up again because it was just so believable, but just kind of amazing that there's actually more self-storage facilities than there are fast food in the US. I mean, when I think about it, I have a son that McDonald's he thinks is the best fine dining on the planet. So I know where a lot of McDonald's are in the area. And when you said that at the expo, I've been thinking about it ever since. As many McDonald's as I see on the way to the McDonald's that he likes, I have seen more self-storage area on the way to the McDonald's. I live in kind of a small area. I live in Siena on the southwest side of Texas, kind of by the Sugar Land area. And even in my tiny little area, I've seen easily 2 to 3 self-storage facilities pop up in the last year. The first being right around COVID when we saw the first construction of one. So I just kind of wanted to reiterate that fact that the amount of self-storage facilities are more than fast food. And I know where all the fast food places are around here with the kids. So that's just crazy. And then your comparison to kind of like what the self-storage, the cell phones were kind of back then. It's like, yeah, of course, I wanted a cell phone so bad back then. But you're right. It was kind of like, yeah, I don't need self-storage. Now we moved from Baton Rouge to Houston about 4 years ago. And we ended up with a storage facility in Louisiana. We have a storage facility in Houston. We finally got rid of our self-storage about 2 years ago in Louisiana. I think we still have one here in Texas. We have an attic. We have 2 garages, and we still have it for we'll go look for those things eventually. We still have it. We're still paying it for it by the month. So I get how people kind of I'm only going to need this temporarily. And we kind of keep these for longer than we intended. So I really wanted to bring that back up. And then there was a quote that you said, date the interest rate and marry the property. I really like that. But could you just expand on that a little for everybody kind of listening in? I just love that quote. But if you could just kind of expand on it a little bit, I just thought that was such a great quote.
Yeah, I mean, at the end of the day, we're in a rising interest rate environment, and there's no doubt that interest rates are going to continue to climb. I think at this point, it's been made very clear. I think the important thing to note, though, is that at some point they're going to go back down, and when you're in an asset that has 30-day leases where we can adjust the pricing on these facilities, the customer's rent every 30 days if needed. We don't do that, but you can keep up with the consumer price index. You can keep up with inflation, and we see growth in revenue still and NOI still, and we see disruptions into the economy on the horizon. So we don't see this rent growth going down. However, it's becoming more difficult to get yield on these properties because we have rising interest rates. So when you have the underlying debt on a property, and you have and that debt is going up and up and up, it's going to make it very difficult to buy a property that is leveraged appropriately, 60-70% leverage, and have net profit. However, if you have these assets and the underlying growing, and there's an opportunity to refinance, say in a year or two, now you've got that revenue growth, and now you have a lower interest rate. So the property is still great. You're married to it. You're in it for the long haul. But you've only temporarily dated the rates the underlying interest rates that you put on that investment that you can swap out later. And so I'm not saying go run after the big interest rates and hope for the best, but the reality is that interest rates will eventually go back down, and these properties that are well located in good growth markets that have growing revenue will still be great investments in the future. And we're in it for the long haul, not for the short term.
I love that. Thanks so much. One other thing I wanted to comment on was the amount of due diligence that y'all really do in a project. When you said, is it important to go through every single bank transaction or to, just trust the profit and loss statement? And you're like, no, go through every single bank transaction and verify it. And that that must take so much time and expense on y'all's part. But I think that says a lot about what y'all do in your investments in your company that, well, we're going to really make sure that this is, something that's really going to work. Can you speak a little bit more about, you went through a lot about the due diligence project, but maybe just a little bit about the philosophy of your company in doing such good due diligence.
Yeah, so I think it just the need to mitigate risk is super important. And the one thing that we do is we have a due diligence committee. So we have a due diligence team. And not only are we sending our contractors to the property and they're doing all of our scoping of budgets, we send our operations team to every facility. We send our acquisitions team to every property. And typically, even investor relations or somebody from the chief officer's department has gone to every property to do our due diligence. But what we do is we have to have regular due diligence syncs, at least weekly when we're taking over a portfolio, where those respective teams are going out and gathering information, getting it into a central location, and then it's being reviewed by a team on a checklist. So that could be everything from your title to your legal, insurance, your financial due diligence, the physical due diligence, and you have to make sure that you're consistent in how you're doing your due diligence on a property, and that's where a checklist comes from. I'm used to checklists. Airlines obviously are incredibly safe to fly on. I think it's the most dangerous part about flying, as they say, is driving to the airport. And the track record is great because there's a checklist, and every pilot that knows if you follow the checklist and stick to the procedures and stop the airplane when there's something that might be a risk or a threat, that is what kind of keeps you safe. And so if you take that same approach to real estate due diligence, you're going to have a consistent, measurable process that you can continually improve. And that checklist has only grown over the years. And so it's important to kind of know that where, your due diligence checklist will change and you will learn new things as you go along. It's not perfect, but that's no different than any other industry, and the airlines particularly, slow to make changes because changes have repercussions. But those procedures and processes are constantly being refined with data and information and accidents to make it better. So we're just really trying to refine that process to the point where we can mitigate a lot of risk for our investors.
I think that's amazing. Of course, at Quest, we're always promoting the need for due diligence, of course, in the investment, in the investor. So I think that's great that y'all take such an amazing approach on that. We actually, of course, I have more questions for you, but this is really not for me. This is for our participants. So we do have Mr. Greg Robinson has a question. What is the average annual IRR on your transactions?
Yeah, so we did an analysis, I believe, a year or two ago, and we've realized about 36% across all of our facilities. But we usually only project 13 to 18% levered IRR, just as a prevention of, as an ounce of conservatism, really makes a big difference. But that's what our track record is so far to date.
Awesome. Thanks so much for asking that question. I, of course, had one more question to ask. You had discussed in the presentation the comparison to the REIT rates, comparison to, where is my little sticky note here? I want to say it was like 18%, and y'all's were a little higher. Can you discuss that a little bit?
Yeah, so we just looked at the REIT data from over the last year, comparing quarter two 2021 over quarter two 2022, and they're reporting 18% increases in revenue, the Extra Space, and then CubeSmart was reporting trailing 12 revenue of about 14.5% increases. We looking back, I actually don't know what our portfolio revenue increase was year over year, but it was pretty sizable. Year over year stuff. But I was mostly making the point that typically we might predict 3 to 8% revenue growth over a particular year. And here we have the REITs doing double-digit annual revenue growth, which has just been tremendous, especially over the past year with all the changes to the environment. So going forward, we see that the REITs are forecasting an average of 13.5% revenue growth increases, and that they're upping their projections. I think it was only high single digits earlier this year. So we're really seeing a bullish forecast from the REITs for the remainder of 2022.
Awesome. Well, thank you so much, Ryan, for being here. I really appreciated it. Amazing information as always. Will you put up your contact? I put it in the chat box or the comment box, but would you mind putting that up one more time if you're able to, or do you want to just?
Absolutely. So I believe you can see.
Just because I know people, if when they have questions, they're going to want to contact you to ask more specific stuff. Of course, they can contact Quest, and we will be happy to give you Ryan's contact information. We have it written down somewhere. There you go. In case anyone wants to.
Yeah, go ahead. Sorry.
No, I was just going to say, in case anyone wants to contact Spartan Investors or Ryan at Spartan Investors, I just wanted to make sure that was out there. And Ryan, yes, what were you saying? I apologize.
I was just going to say, anybody can reach out, Ryan at Spartan-investors.com. So
awesome. Well, thank you so much for being here. We really appreciate everybody tuning in today at noon. Of course, if you tuned in late, or sorry if you tuned in right at 12 when we weren't quite ready yet, we were dealing with all of our little technical issues that prevented us from starting on time today, but we got through it and we made lemonade out of lemons, and we still had a fabulous presentation. So thanks again, Ryan. Thanks again, everybody, for your patience and for joining. And of course, you can catch the replay on YouTube. So have a wonderful rest of your Saturday and weekend. We will be here next Saturday, same time, same place, noon Central, bringing you another amazing guest in self-directed investing. So have a wonderful weekend, everybody. Thanks so much. Bye, guys.
Thanks, Nicole.
Thank you. Thanks so much, Ryan.